While the world was distracted by headlines designed to keep you angry and divided, a silent coup was completed in a glass tower in Midtown Manhattan. On January 14, 2026, BlackRock quietly published a report that confirms what financial insiders have feared for a decade. They now manage $14.21 trillion. To understand the scale of that power, if BlackRock were a country, its economy would be larger than Japan, Germany, and India combined. But here's the part they don't want you to see. They aren't just an investment firm. They are the invisible central nervous system of global capitalism. From the house you rent to the hospital that treats you, and even the central bank that prints your currency, every road now leads back to one man, one algorithm, and one firm. Now here's the thing. You've probably heard the name BlackRock before. Maybe you think they're just another investment firm like Fidelity or Vanguard, but that's exactly what they want you to believe. Because while you were told that democracy and free markets determine the shape of the modern world, a single corporation has quietly positioned itself as what financial insiders now call the fourth branch of government. They don't need to win elections. They don't need to pass laws. They simply own enough of everything that laws bend around them. I'm not here to sell you a conspiracy theory. I'm here to walk you through public SEC filings, central bank records, and testimonies from former Treasury officials that reveal a mechanism of power so sophisticated that most people don't even realize it exists. By the end of this video, you'll understand exactly how BlackRock went, from a risk management startup in 1988 to the single most powerful private institution in the Western world. And more importantly, you'll see why what they're planning next could fundamentally rewrite the concept of ownership itself. Let me take you back to 1988. A trader named Larry Fink had just blown up a $100 million mortgage portfolio at First Boston. He'd misread interest rate risk, and it cost him his job. Most people would have slunk away in disgrace. Fink did something different. He realized that the entire financial system was flying blind. Banks, pension funds, governments, they had no idea how much risk they were actually carrying. So Fink started a firm with a single pitch. We'll build a computer system that can see risk before it destroys you. That system was called Aladdin, Asset, Liability, Debt, and Derivative Investment Network. At first, it was just a glorified Excel spreadsheet for bond traders. But Fink understood something fundamental. Information is the ultimate form of leverage. If you know what everyone else is holding, you can see the whole chessboard. Within a decade, BlackRock wasn't just analyzing risk. They were managing assets for clients who didn't want to think about risk at all. Then came 2008. Lehman Brothers collapsed. Bear Stearns evaporated. The entire Western banking system was on the verge of systemic failure. And who did the U.S. Treasury Department call? Not the SEC, not the IMF. They called Larry Fink. The Federal Reserve hired BlackRock to manage the toxic assets from the bailout programs. The same thing happened in Europe when the European Central Bank needed someone to handle distressed portfolios. BlackRock became the cleanup crew for the global financial crisis. But here's where this gets interesting. When you're hired by governments to manage their most sensitive financial operations, you gain something priceless, access. You see the internal data, you attend the closed-door meetings, you become the trusted advisor that central bankers call before they make policy decisions. And in that process, the line between public institution and private contractor starts to blur. By 2015, BlackRock wasn't just managing money for pension funds. They had become the largest shareholder in Apple, Microsoft, ExxonMobil, JP Morgan Chase, and Pfizer. They weren't just investing in the economy, they were the economy. When the Bank of England needed advice on post-Brexit monetary policy, they consulted BlackRock. When the German government wanted to understand climate finance risks, they turned to Aladdin's algorithms. The firm that started as a bond shop had quietly become the central nervous system of global capitalism. Now let me show you something that changes everything. Aladdin isn't just software. It's a real-time surveillance system for the global economy. As of February 2026, Aladdin monitors over $22.4 trillion in assets. That includes not just BlackRock's own holdings, but the portfolios of more than 240 institutional clients, insurance companies, sovereign wealth funds, central banks, pension systems across North America and Europe. Here's the actual math. Aladdin processes 200 million calculations per day. It tracks over 30,000 investment portfolios simultaneously. It analyzes bonds, equities, commodities, derivatives, real estate, and increasingly, private infrastructure assets. The system runs Monte Carlo simulations on millions of possible economic scenarios, recession, inflation spikes, currency crises, geopolitical shocks, and automatically rebalances portfolios before human traders even finish their morning coffee. Stop. Before we go further, you need to see this clearly. When the Federal Reserve debates whether to raise interest rates, Aladdin has already modeled every possible outcome. When the European Central Bank considers quantitative easing policies, BlackRock's algorithms have already calculated the capital flows. They don't react to policy changes. They anticipate them. And because they manage such enormous positions, their moves create self-fulfilling prophecies. If Aladdin predicts a sector will outperform and shifts $50 billion into those stocks, that sector will outperform simply because BlackRock bought in. I pulled the SEC 13F filings from Q4 2025. Let me walk you through what they actually say. BlackRock is now the top institutional shareholder in 17 of the 20 largest defense contractors in the United States and Europe. They're the top shareholder in 6 of the 7 largest pharmaceutical companies. They hold dominant positions in energy infrastructure, semiconductor manufacturers, and cloud computing platforms. When you use an iPhone, drive a car, take prescription medication, or heat your home, a fraction of that transaction flows back to BlackRock's balance sheet. But that's not the full story. In January 2026, BlackRock announced a strategic pivot. They're moving aggressively into what they call private markets. This is the final frontier. Public stocks are yesterday's game. The real wealth is in assets that don't trade on exchanges. Private equity stakes in infrastructure, data centers, logistics networks, water utilities, even agricultural land. According to their own investor presentations, BlackRock plans to deploy $300 billion into private infrastructure by 2028. They are not just buying financial instruments anymore. They're buying the physical machinery of civilization. 3 separate sources confirmed this independently. Reuters reported in late 2025 that BlackRock had partnered with sovereign wealth funds to acquire controlling stakes in European electricity grids. The Financial Times documented their purchases of data center facilities across Germany and the UK. Bloomberg revealed that BlackRock's real estate division had become the largest institutional landlord in over 30 American metropolitan areas. You don't just invest in BlackRock. You rent from them, you work for companies they own, you consume products they've financed. Now here's where this gets uncomfortable. On January 20th, 2026, Larry Fink appeared at the World Economic Forum in Davos. In his keynote address, he used a phrase that most people didn't understand: the tokenization of financial assets. If you weren't paying attention, it sounded like typical corporate jargon. But if you understand what tokenization actually means, you'd recognize it as the blueprint for the largest transfer of control in modern economic history. Let me explain exactly what's happening. Tokenization means converting real-world assets, stocks, bonds, real estate commodities, into digital tokens on a blockchain. Think of it as turning every asset into a programmable piece of code. On the surface, this sounds like an efficiency improvement. Faster settlement times, lower transaction costs, more liquidity for illiquid assets. But ask yourself this: who controls the blockchain? Who writes the smart contracts that govern how these tokens can be traded, frozen, or seized? According to a report published by BlackRock's Global Allocation Investment Team in December 2025, the firm is working with central banks and financial regulators to create a unified digital asset infrastructure. The pitch is simple: bring all financial assets onto a single interoperable blockchain system. Replace the messy patchwork of stock exchanges, clearinghouses, and title registries with one seamless network. And who's providing the technology platform for this transition? Aladdin. BlackRock is positioning itself as the operating system for the tokenized economy. Watch what happens when ownership becomes digital and programmable. Right now, if you own a house, you hold a deed. That deed is a physical or digital document that gives you sovereign control over that property. But in a tokenized system, your ownership is a smart contract. And smart contracts have terms. They can include conditions. They can be updated. They can be revoked if certain criteria aren't met. Maybe you missed a tax payment. Or maybe an algorithm decided your property is needed for public use. This isn't speculation. I'm reading directly from BlackRock's own white papers. In their vision for 2030, all major asset classes will exist as tokenized instruments governed by decentralized ledgers. Except the ledgers won't really be decentralized. They'll be managed by a consortium of institutions, central banks, mega asset managers, and technology firms, with BlackRock sitting at the center. You'll still own your home, your retirement account, your car. But that ownership will be mediated through systems you don't control, governed by rules that can change without your consent. If this sounds dystopian, consider what's already happening. In Q4 2025, the European Central Bank announced a pilot program for a digital euro. The Bank of England is developing its own central bank digital currency. The Federal Reserve is researching the Fed's recent programmable infrastructure white paper, a programmable dollar. Each of these projects involves private sector partners. And guess which firm is advising all 3 central banks on the technical architecture? That's right, BlackRock. Now, let me show you the 3 scenarios for where this goes. Best case scenario, tokenization genuinely improves efficiency. Transaction costs drop, financial inclusion expands. BlackRock remains a powerful player but is constrained by regulatory oversight and market competition. Governments maintain sovereignty over monetary policy. citizens retain meaningful property rights. This is possible if, and only if, regulators wake up in the next 18 months and impose structural limits on asset manager concentration. Most likely case, we get a hybrid system. Tokenization happens gradually. Most people don't notice the transition because their day-to-day lives don't immediately change. But over a 10 to 15 year period, ownership becomes conditional. Your retirement account is tokenized, which means it can be automatically rebalanced by algorithms during market stress without asking you. Your home is tokenized, which means property taxes and insurance premiums are automatically deducted from your wallet. You still make choices, but the range of choices narrows. BlackRock doesn't rule you directly. They just make sure that every economic pathway leads back through their infrastructure. Worst case scenario, the system becomes explicitly extractive. Economic crises in the 2027-2030 window, debt defaults, currency instability, energy shocks, create the justification for emergency measures. Governments, desperate to stabilize markets, grant unprecedented authority to private asset managers to maintain liquidity. Tokenized assets are frozen during panics. Property rights are subordinated to algorithmic risk management. BlackRock and a handful of peer institutions effectively become private central banks, allocating capital not based on productivity or innovation, but on system stability as defined by their own models. This is corporate feudalism with a Bloomberg terminal interface. Which scenario happens depends on choices being made right now in regulatory agencies and legislative committees that most people will never hear about. If you're in the UK, the Financial Conduct Authority is currently reviewing asset manager concentration rules. In Germany, the Bundesbank is drafting guidelines for tokenized securities. In the United States, the SEC is deciding whether to classify certain tokenized assets as securities or commodities. These bureaucratic decisions will shape the economic sovereignty of the next generation. So what does this mean for you? Let me be direct. If you're a salaried professional in the US, UK, or Germany, your retirement savings are almost certainly managed, directly or indirectly, by BlackRock. If you rent, there's a decent chance your landlord is a corporate entity with BlackRock as a major investor. If you work for a publicly traded company, BlackRock is likely one of the top shareholders, which means they vote on executive compensation, board composition, and strategic direction. You can't opt out of this system entirely, but you can become literate in how it works. Here are 3 specific things you should watch in the coming months. First, monitor central bank digital currency rollouts. If the Federal Reserve, ECB, or Bank of England announce full-scale CBDC implementation with private sector infrastructure partners, that's the starting gun for tokenization. Pay attention to which firms get the contracts. Second, track BlackRock's private market acquisitions. If they start buying up distressed assets in a specific sector, say regional banks in the US or utility companies in Europe, that's a signal that Aladdin's models are predicting a crisis in that sector. They're not fortune tellers. They're just reading the data faster than everyone else. Third, watch the regulatory battles. If you see news about antitrust investigations into asset manager voting power or debates about fiduciary duties and passive investing, those aren't boring technical issues. Those are fights over whether democratic institutions still have the authority to constrain concentrated private power. Let me acknowledge something important. We don't know for certain how this ends. BlackRock executives aren't cartoon villains plotting world domination in a boardroom. They're rational actors, optimizing for profit and influence within a system that rewards scale and information asymmetry. The danger isn't a conspiracy. The danger is a mechanism that operates perfectly according to its own logic, even if that logic produces outcomes no one actually chose. The question isn't whether BlackRock is evil. The question is whether Western democracies will allow a single private institution to become systemically indispensable to the functioning of the entire economy. Because once a firm is too big to fail, it's also too big to regulate, too big to prosecute, and too big to challenge. And at that point, it doesn't matter who wins elections. The real decisions are being made in an office tower in Midtown Manhattan by an algorithm most people have never heard of. This isn't the end of the story. It's the beginning of a much larger investigation into how power actually works in the 21st century. If you want us to keep digging into these systems, the ones that operate below the headlines, the ones that shape your economic future, whether you pay attention or not, then subscribe to this channel. Verify every claim I've made today. Pull the SEC filings yourself. Read BlackRock's annual reports. Look at the institutional ownership data on Yahoo, Finance, or Bloomberg. The information is public. The question is whether enough people will bother to read it before the window for democratic accountability closes. Because once ownership itself becomes programmable code, written by institutions you don't elect and can't audit, the very idea of economic sovereignty becomes a historical curiosity. And that's not a future we should sleepwalk into.